Welcome to Trade with Books. Today we are going to see that which are the stocks where you can find opportunity for this market fall, where is the opportunity for value investing and what should be the approach in this falling market. So if we see that because of that Trump's tariff again market has started falling like anything, and this is the time for again looking for the strong stocks which are currently available at very cheap value or at a value where you can start investing in those levels. And if you have the patience, then again that same stocks will go in 3 to 5 years to the new heights. So how to identify that what should be the approach, these all things we'll see in detail. So if you see that currently that in nifty is below that 250-day moving average. The simple thing which I use is that simple moving average you have to add in the nifty chart. In the nifty daily chart you can add a simple moving average. So in TradingView I am using, you have to add an indicator that is simple moving average. And this is very simple because the name is simple. So you have to change the setting to 250 days. So what I'm going to see is that last 250-day working days average, whether Nifty is below that or above that. So when I applied that, I will find that Nifty is below the 250-day moving average, and it is it is trying to go up, but again from that level, same level, selling came. So it is below the 250-day moving average. Now how often that does that Nifty is below 250-day moving average, how often it comes? So for that, if you want to go back, we will see that. So here once in 2023 for some 20 working days, Nifty came below the 250-day moving average after a fall. After a fall of almost around 10%, it came below the 250-day moving average. Now a simple rule, if you follow that, whenever Nifty comes below 250-day moving average, I will start buying the Nifty 50 companies. Nifty 50 companies which are, I know that, which are very strong companies. And this will again when Nifty will start going up, these companies will again make a new high. So with this simple strategy you can make that 50 to 100% returns. But you have to believe this, that Nifty will go up. So here in 2023 market came below 250-day moving average. Here you can see that Russia Ukraine war was there in 2022 times. So market was below the 250-day moving average for around 4 5 months, and this was the time where all the multi-bagger stocks which are already become multi-bagger, Nifty 50 stocks, big companies, they were available at very good reasonable value. If those levels you start buying, averaging out those companies, after this period was over, these companies has given double, more than double returns, like 100% returns. Many of the companies have given. You can see that of any company, you can go and search for the levels of 2022 January to June levels. You will find that when Nifty was below 250-day moving average, they were available at very cheap value. And the last time before that, you see that COVID time market was below 250-day moving average. So I can be sure that whenever Nifty comes below 250-day moving average, that is the time to buy fundamentally good stocks, because they are also beaten up. When market selling comes, nobody sees that good or bad companies. A sentiment develops and every stock will be beaten up. So your stock which is fundamentally good, which is showing EPS growth, that also will be beaten up by the market, and that is the time it will be available at a bargain value, at a lesser price. You don't know how to catch the bottom. So what you can do is you have to do averaging in those fundamentally good stocks, not in every stocks, not in the stocks which you have bought and which is available at a P ratio of 100. No, I am talking about the stocks which are available at the P ratio lesser than their EPS growth. Yes, that is the magic formula. Their P ratio should be lesser than the EPS growth rate. Then you can consider buying that. That ratio is called PEG ratio, P divided by growth ratio. That should be less than 1. Now the growth you can see of the TTM growth and the future growth also, both you can see. TTM growth means trailing 12 months growth, that is available in the screener.in, and also the future growth, how to see the future growth. So many analysts are there, they predict that what can be the future growth. That data is available on Yahoo Finance. I will show you both of them, you can use that. So first thing is that we developed a methodology that whenever Nifty comes below 250-day moving average, it is the time to buy low. And then when the market will go up again, make a higher high, higher low again, then we will consider selling at the higher level. So buy low, sell high. This is the simple strategy. Now why we are talking about that? Because when a fundamentally good stocks, because of market correction, correct from 100 to 10, this is a fall of 90%. But when the market will start going up, since this stock is fundamentally good, this will again go to 100 at the same level. That time this gain will be 900%. Okay, so because of that we are trying to buy at the lower level. This is the whole theory, this is what we are trying to capture. So first thing is that Nifty is currently below 250-day moving average. Now how we can now the second thing is which are the stocks to buy. Before that I will take you to show that how the good stocks also fall and how they recapture their value. Since I cannot show you Indian examples of the stocks because of SEBI regulations, I will show you American good stocks which I can name it also, that Meta. Now every day we are wasting our most of the time on Instagram and Facebook. So Meta is that company which runs that. So it is a good company because its sales is going higher and higher only. So if you see that during this period and before that also, this all are correction periods. If you buy them in the correction period, while the correction is going on, what you will see, the headline that Meta has corrected 75% from its high. 75% means 100 rupees stock has become 25. That is the kind of fall Meta has seen in 2022 when the Russia Ukraine war was there, which I was talking in our Nifty chart. Our also stocks fallen like that only. If you go and see the big names, that also fallen in that period like that. And that was the time everybody was afraid. But that is the time to become hopeful. And when the market was at the all time high, people were hopeful that it will be double. That is the time to be fearful. So people are doing ulta. So now is the time to be hopeful that after this fall, if I will start averaging here also, if I cannot say that you can catch the bottom, but you have to start buying this stock at these levels. So when this go up, you can enjoy the rally. This is the simple thing you can do. A layman investor, a general person who is doing a job also, what he can do, the known name, the good companies, he knows that they will not going to be shut down. That companies, when they are available at the lower levels, he should buy them and hold it for long term. And he should buy at every level. This is the thing, simple thing he can do. He should not go and explore the small cap and mid cap where a lot of risk is there that these companies may not go again to that same levels. So Meta is there. Nvidia, everybody was talking about Nvidia, but when Nvidia was at the lower level, when Nvidia was available here, how much fall it already had? If you see here, if I will tell you to buy this Nvidia, you will tell me this stock is down almost 65%, means 100 rupees stock has become 35. So how I can buy? But if you buy at these levels, $10, $20, it has gone to $150 also. So that is the kind of returns it has given if you buy at the lower levels. But somebody who is now buying at very high value where margin of safety is not there, there always the risk is there. So you better start watching the opportunity where the most of the fall is there, and then you see that analyze those sector big companies. Suppose currently Nifty IT has been beaten up because of that US recession fears and tariffs. Now after this much fall, many of the IT giants, now they are available at very good valuation. For the example, just for an example, and how you can see the growth rate estimate, I will take you to the Infosys example. So what you have to see is that whether the current P, any company's current P ratio is lesser than the EPS growth, is lesser than the EPS growth, because EPS, this is the thing which is used by many of the big fund managers also. EPS growth, you cannot say P is more or less. You can compare the P with something. That something is EPS growth. EPS growth is, if last year EPS, earning per share, was 10 rupees, and this year if it is 15, that EPS growth is how much? 50%. How much is there? 50% growth. So if the stock is available at less than 50 PE, I can say that stock is in bargain for the current time, until unless this changes. If this EPS growth doesn't comes, then you have to readjust the P. This is the simple thing. So if fifth class maths you apply and this EPS growth you brings this side, other side, then it will be P divided by EPS growth. Like this, the formula. P divided by EPS growth, not the EPS. Then this should be less than 1. And this same thing is called what? PEG ratio. This is what called PEG ratio, PEG. PEG ratio should be less than 1. Now with this simple thing you can find out many stocks, whatever stocks you want. Just you have to go to screener.in. Where you have to go? Screener. This is screener.in. You have to create a screen, create a new screen and write PEG ratio should be less than 1. And now you run the query. You will find 1550 stocks, but you cannot analyze all the stocks. So you have to write here and you write the market cap. Market cap should be, suppose you are looking for only giants, you are looking for only large sector companies, because small and mid caps are risky. So we will take 10,000 crore, suppose 10,000, you can choose any number, 10,000 crore companies I want to see. So still now only 142 companies came, 142. Now in this 142 companies you can go and see whatever else parameter you want. Suppose you want that I want a P ratio less than 50 company only. Only I want to invest in a company which is lesser than 50 P ratio. So you can just click 120 companies came. Now if you want to invest in less than P 30 companies, only 88 companies came. Any other parameter you want to write, you write and write ROE. ROE, return on equity, you want at least more than 15%. So you click that, only 59 name came. So like that you can find out the companies. The second thing, where to see the EPS growth. So two things are there. One is that EPS of last 12 months, TTM EPS. So here in screener.in, if you write any company's name and go down, and here one table is there, compounded profit growth. Here you see compounded profit growth. So here you can see the TTM profit growth, trailing 12 months profit growth. This you can compare with the P ratio. This you can compare with the P ratio, current P ratio. So current P ratio is 21. So if that 21 would have been lesser than 13, I would have told that this stock is currently undervalued. So like this, I used to check that whether the stock current EPS growth is more than the P ratio or not. If you want to see what is the prediction for the future growth, what people are, the big players, the big analysts are expecting the Infosys to do in the future, so you can come to Yahoo Finance. Yahoo Finance is a free website, and analysis you have to come here, analysis, and here you can see lot of data, like what is the analyst recommendation, what is their price target. Then the most important data is this one, growth estimate. In free, I have not seen many places where this data you will get. Growth estimate. What is the growth estimate? So for Infosys, you can see current quarter is minus 16%. Minus 16%. That is the reason stock is falling. Wherever earnings will fall, stock prices will fall, because earnings are the prices are the slaves of earning. This is the thing in stock market people used to say, because stock is nothing but a piece of a business. So if business will not earn, the stock prices will go down only. So next quarter you see that earning projection is 11.38%. It is projected, expected. Current year it is 0.8%, whereas in next year it is estimated as 10.9%. So next year it is higher than the current year. So EPS growth is predicted. So based on that, you can decide whether these are the levels. You can start investing in such big giants. Then your average price will be at the low level. Suppose you cannot know that now this stock will make a bottom. What you can do, if you have 1 lakh to invest, you can start investing 25,000. Then if stock again fall 10%, you can again put that 25,000. If that stock again goes started up, no need to put anything, you can be at your seat. If now you will tell, suppose now stock will never go down, what happened? At least 50,000 you have put na, you have not missed the rally. You can put other 50,000 in other some other stocks. But like that, you can do averaging in good, fundamentally good stocks. How you can find out fundamentally good stock, that also I have explained in screener. The stocks which you are having, I will recommend you go and see what is the growth estimate for that stocks, and what is the current EPS growth in that stock, what is the P ratio available, whether the P ratio is lesser than the growth estimate or not. So that things you can see, and then you can decide. Based on that, you can take a decision. So this was the whole topic. Hope you like it. Consider subscribing. I will see you in next video. All the best.